Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news closely related to the metals. Before we get into the news, maybe we should take a look at the metals. So, Tori, how's the market looking now that we're firmly into third quarter? What's this previous week looking like?
It's looking like maybe we did see the low for the summer. I don't know. I mean, just continuations here of last week's program and the start of the quarter. Gold this week is up 1.7%. So we were $2,330 last week. So we're up $40 to $2,370. But we were up $60. We were $2,390, up over 2% earlier this morning. It's given a little bit of that back. Silver's up 4.2% this week, from $29.50 to $30.82 as we record. And that's driven the gold to silver ratio down below 77. So we're now in the 76s on the gold to silver ratio. Platinum and palladium are the other two. Platinum is flat, still stepping upwards. We'll take a flat week. And it did get up to 1,030, so it was nice to see a little pop there. But palladium continues its decline. It's down 2.8% from last week's recording, from 1,008 to 981. In all fairness, that 1,008 had been a little bit of a pop that was unexpected. So I would say palladium, it's obviously down about 3% so far this year. But the equities continue their march. S&P up 2% as well, from 5,500 to 5,600. And that all coincides, metals up, equities up, with the U.S. dollar down. So pretty consistent trend there. The U.S. dollar index is down from 105.6 down to 105. So it's only down half a percentage point this week, but still that's a good indication as to why.
Yeah, marginal week, I would say a reasonable week across the board. I think the two big movers obviously are silver. The over 4% move on silver in a week is big, and I think that's good pointing out that, man, that ratio really is looking like we're hitting that kind of middle of the road break point. I was talking to one of our chartists here, Eric, earlier today, just kind of looking at the gold silver chart and some of the data he's been trying to draw out of it over the last 40 years. And I sent a chart back to him that I'll actually toss up here on the screen, because this is my elementary charting compared to the actual experts in the room. But I just look at these sort of chunk periods of time in the gold-silver ratio, where you have this 5-10 year period where you were kind of on the down end of it back in the 70s. Then we spent some time above it through the 80s, below the midline through the 90s. We've obviously been above it for a number of years here now through the mid to late 2000s, as the ratio has really been trading between 60 and 120, give or take, going all the way back to the bottom we hit in, 2015, when we hit that 30 or so to 1, 2012.
Yeah, we saw that in 2011, actually. And that's
2011,
yeah.
So farther back than I even remember.
Yeah, because I doubt that. You were still here then, but
I was here.
Yeah,
that is true.
But that was when silver spiked to that all-time high of 50. And so it was a real brief little blip on the radar, but still that set the low, that it was 31.
And we've been in that extended period of time after you moved above that midline for 10 years, where the trading of the gold-silver ratio has not been from top to bottom, but from top to midline. So eventually, when I glance at this gold-silver chart, I see a period maybe of a 5 to 10 year period where, again, we shift back to the bottom end of that line. So we're all kind of waiting for that big shift down below that midline. We're now looking at gold silver pricing, not trading between 70 and 90, 70 and 100, but maybe trading between 70 and 40 or 70 and 50. So we'll just have to see how that plays out. But the gold silver ratio chart is looking very interesting to me, just from a theoretical, a macro standpoint.
Well, and taking that macro standpoint into account, I mean, we're in the middle of the channel right now, right? So maybe we're not as aggressive on the silver side of the fence as we were 2 months ago, where we were doing a greater percentage of a trade in silver. And those clients have been rewarded, because silver has obviously outperformed gold and driven that ratio down. But remember, about 6 weeks ago, we got as low as 72 to 1, maybe 8 weeks ago, down to 72 to 1 before it reversed back up to 80. And you're right, though. I mean, in 2021, in February of 2021 is when we hit the recent low of 62 to 1 in that ratio. So we haven't even seen 62 since 2021. It's already been more than 3 years when we hit that. So it's hard to predict timing. As you've always said, the when is the tough part. Ultimately, we just know that it will get there because we have so many decades of data and so many different economic impacts that can get us there slowly or quickly. Ultimately, we'd still end up seeing it. But the middle of the channel is a place to proceed with caution, because from here, you really need silver to spike up to over 107 to 1 or 100 to 1 at least before you'd be selling any gold moving into silver. And from here, you really need the ratio to come down into the 50s before you'd be selling silver and moving into gold. That's the issue here. So tread lightly on that ratio, but you can always call us and we'll see where your individual entry points are and where obviously your individual exit points would be on product that you've already acquired.
Yeah, the no man's land is always a hard place, right? Because if arguably you could take this back throughout history and the way the gold silver channel has sort of been rising over time, you could almost argue we're pretty close to at parity right here, at reasonable ratio pricing, averaged ratio pricing between the gold and the silver. So that's where being real specific with your metals purchases right now and looking at a more balanced portfolio so that you've got the basis covered. There's one base that no matter where the gold silver ratio is in that 70-ish range, that's sort of in this no man's land, there's one piece of that puzzle that I think everybody needs to be on the correct side of, and that is a small stake in platinum. So I think it's worth taking a look. I keep saying this every week, so this is going to be the week, Tori. We're going to take a little look at platinum and palladium here. I think it's worth it.
Okay, I like it. Let's do it.
So platinum here, I think we've been bringing this up now. Platinum taking that big jump back in 2020, going from 590 all the way up to 1330. So very big 2 steps forward, very solid 1 step backwards. Looks a lot like the gold price did, except we're just looking for the catch up, just like we're looking for the catch up in silver. And I think we're starting to see it in silver with the way the ratio is moving. We're looking for the catch up in platinum. What's crazy to me is that platinum to gold ratio has put in like new lows. We really thought we were scraping bottom here a year or so ago, and that platinum to gold ratio is definitely scraping new lows. So I don't know what it's going to take. You know, I've had this conversation with a number of clients now over the last couple of weeks. I don't know what it's going to take. I don't see a value better than this one in the metals markets. The only thing about it that's frustrating to me is not the time it may take from here going forward, but the fact that, to me, it's looked like the best value in the metals markets for years at this point, for the last couple of years.
Well, it has been. You're exactly right. It has been, and that is not a cause for switching course. Don't get fatigued with your platinum. We cap it at an 10%, sometimes as high as 20% of the metals portfolio is not going to be predominantly platinum. But all that to be said, that enables you to remain patient. A lot of quarterly reports going out to our clients just as we give them updates on their metals holdings. Certainly you'll see that platinum has been lagging the performance of the gold and silver. It's been doing far better than palladium in its massive decline, but still we want to see things appreciate. So stay the course with your platinum, and one of these days you're going to be rewarded with additional silver or additional gold or additional palladium.
And we get that question too. What are we swapping into? I think the best answer to that question is the thing that makes the most sense at the time.
Value.
Yeah, the value. And that's the great thing about ratio trading is it takes all emotion and decision making out of it. I don't know who has, Tori, but there's a great little 3-minute video clip that Dave put together when he was talking through some stuff to some clients of ours here recently, and I think our team clipped it and pulled this little 3-minute video clip out where David is just explaining the concept of the gold-silver ratio. I don't know who's gotten to see it yet, but I think that's a good thing to share with people. So if you're out there listening and you'd like probably one of the most perfect little 3-minute explanations of the value of ratio trading and why it's such an important piece of the puzzle, you can click the link in the description below or call your advisor and we can email it out to you. But I think he did a fantastic job of just summarizing everything. And I've sent that out to a handful of my clients here over the last couple of weeks because I think it's just the perfect example.
I agree. And the other thing that we've got to keep our eyes and ears on is just the underlying fundamentals. And when people say, well, what's going to happen next? Where are we going to go? And I started the show by saying maybe we did put the floor in. I don't think we've seen the floor in the gold to silver ratio. I don't know that we've seen the floor in the silver price or the gold price. The further we get into July, the more pressure we have to the upside on the metals starting to reverse and climb and go back and touch those previous highs in this cycle. You know, silver was at 3250, gold 2450. That's not very far away from where we are now. And I would like an additional pullback. A couple weeks ago, we put those retracement levels or those support levels up for you to see where those potential entry points would be if we did get those pullbacks. But if it doesn't happen, I mean, we've said over and over again, where we are right now is an incredible value compared to where we're going to go. And I know that the world is watching and waiting to see what our central bank does with the Federal Reserve lending rate. And Powell was speaking for his monetary policy report to the Senate Banking Committee yesterday, and he basically said, look, it's not likely that the next Fed move will be a rate hike. Well, we know that, but that doesn't say that it absolutely won't be. It's unlikely, but that to me takes away from the propensity for there to be a rate cut also. And he said easing too soon, too much could harm the inflation progress. So they're still clearly worried about inflation. And that made me think, well, maybe we're not going to see a rate cut before the election. That's different speak because he admitted that the Fed continues to make decisions on a meeting by meeting basis, which we would expect. And a lot of it has to do with the labor market. And the misleading point here, the labor market appears to be fully back in balance, according to our Fed chairman. But then you've got Senator Kennedy asking him about the fact that 75% of the jobs being created are by the government. That's not a real labor market, right? That's the government stepping in and trying to rescue a labor market that they're trying to manipulate and control so it's not too hot, so inflation's not too hot.
Sure.
And unfortunately, that leads to all sorts of risks. But the commercial real estate risks are still there too, and that might last for years, according to Powell. And I think that that's right. And despite all of that, the stock market continues to climb. I mean, here's the S&P 500. Now it's up, almost 29% higher than where it was when the Fed started hiking rates.
Right.
In an interest rate hiking environment, you've seen certainly bond yields increase, but you've seen these equities hit all-time highs. You've seen gold hit all-time highs. Something's going to give, Miles. And when it does, I would think that we would get a whipsaw effect, not only in the Dow to gold ratio, but in the gold to silver ratio and some of these other ratios, maybe even the gold to oil ratio. There's a lot of variability that hasn't really been there here that we have yet to see play out.
Here's a fun little stat that I was talking with my brother-in-law about this past 4th of July, and he's in the C-suite over with the Raytheon conglomerate of many companies. So he's looking at things from the other side of the investor platform. The guy's selling the shares, not the guy's buying the shares of the company. So he and I were kind of looking at some stuff, and he brought up an interesting point that I've gone back and checked. So the last couple, Greenspan, Trump, and now Powell, from when you started raising interest rates to when they had to crash rates. Greenspan and Trump, what do you think that duration was? They said, we're going to start raising interest rates, and holy smokes, we're taking them back to zero. It's almost identical for both time-wise. How long do you think?
2 years?
Yeah, 40 months.
Wow, a little more than 3.
Yeah, post-Volcker to, let's say, Clinton. 2000. It was really more like 20 months. So it was more like your 2-year estimate where we'd start to raise interest rates and then we'd drop them after about 20 months. Start and then drop them, start and then drop them. Greenspan got about 40 months before he had to tank them. Trump got about 40 months. Powell's at 28. So going back to February of 22 at 0, and then up until now June of 2024, we still have yet to drop interest rates. So if we're going to follow a similar pattern, it's arguable that we could see something as a result of these interest rate rises. And I don't think it's the stock market. I think you're dead right there. The stock market would be hurting with the interest rate rises. I am very, very concerned this is a Main Street, not Wall Street problem. Interest rates come down because people are losing houses, mom and pop shops are going out of businesses, and more importantly to Wall Street, because they don't really care about Main Street as long as things are plugging along. But what is more important is the underlying banks that have written those commercial loans on that commercial property you just talked about, or the working business loans. They're not getting paid back. And I think that's where the problem lies, and that's where we end up seeing the interest rates come back down, is when we have a banking crisis caused by the inability of the average American to pay the bills. I don't think this is a Wall Street crisis. I think this is a Main Street crisis. There's my negative Nancy Miles again. I was all optimistic last week. I'm getting pessimistic again this week.
Well, I'll be pessimistic with you. I mean, I think that that's wise, but the inflation and the interest rates are two things that we are telling our clients to expect to remain higher for longer. So listening to David and Kevin on the McAlvany Weekly Commentary and the guests that they have, I mean, these are people that are in the know. Your business model or your personal budget need to plan for higher inflation and higher interest rates for the foreseeable future. Do not be banking on a rate cut, because you're just going to get pulled deeper and deeper into the abyss. So start to adjust things accordingly as if this is going to be the new norm, because for decades it was the norm.
Yeah.
And it will be again. And what happens if they do cut? I think it's great that you pointed out the rapid pace at which they cut the rates. That's usually going to be in response to some economic calamity. Well, what happens when they cut rates aggressively and quickly? The US dollar is going to drop. It's going to coincide with quantitative easing, meaning money printing, like the central bank's going to be flooding the system with money, and that means gold goes up. So to me, gold has nowhere to go but up, because they know that they need to cut rates at some point, either out of an emergency type of a situation or just starting to stimulate the economy. And we'll see what happens politically, right? I mean, a lot of that's going to depend on political pressure and what economic policy is with either an existing administration or a new administration. I think any way we shake it up, we're in for a new administration come November. That's almost a guarantee now. The incumbent has the lowest rating of any president in modern history and is on the fence in terms of whether or not he's actually going to be the nominee. So to me, there's going to be political change. There will be a new administration and a new direction economically. And I think with that is naturally going to come a need to stimulate in some capacity. And that
Sure.
means gold goes up.
Well, and that rate cut doesn't have to go to zero. You know, that we talk about the stair stepping in markets. Interest rate cycles are 50 plus years round trip. Sure, we have a rate cut, but maybe they cut to 1.5 or 2, and then it goes up to 7 or 8. And then we have a problem and they cut to 3 or 4, and then it goes up to 10. Like, we could be looking at a stair stepping up of interest rates over the next 15, 20 years. And now you're having to navigate locking in home mortgage prices at certain rates and maybe rolling things over at different years. And, you know, now you've got a whole new market to play around with. We've been pretty lucky over the last 20 years of just being able to trade free money. The end of that era, I think, is in front of us. So we'll have to see. But yeah, I agree with you. It's a bumpy year. I'm glad to see gold up. I'm not surprised that it's holding this summer despite all of our complaints. I'm not shocked at all that we haven't gotten the pullback in gold yet we all wanted. And frankly, we just might not.
Well, especially geopolitically, it's only going to ramp up with Israel. Between Hezbollah and Iran, I don't see how that becomes more pacified here in the coming months.
Sure.
That alone will be enough to get gold climbing again and setting those new highs. So keep your seatbelts on, adjust your budgets accordingly for higher inflation and interest rates for the long term. Add to ounces on every dip that you can, but most importantly, just give us a call and let's walk through the portfolio exercise. We can walk through the entire investment triangle that we've followed for decades, and you can then walk away knowing, hey, this is where my portfolio is. This is where I want it to be in terms of your diversification. What role do the metals play? That's going to be a minority role, but we're happy to weigh in on the remainder of the portfolio and that paper management and assist you in that regard as well.
Yep, I like it. That sounds like a plan for me and hopefully our clients as well. So thank you again, Tori. Appreciate it as always. And for our listeners out there in YouTube land, we appreciate you joining us as well. As Tori mentioned, if you have any additional questions, you can certainly find some more information on our website at McAlvany.com. ICAgold.com. We're also on Twitter at ICA Gold or Facebook at McIlvaney Financial. But better yet, why not give us a buzz, have a conversation with your advisor at McIlvaney Precious Metals. We can be reached at 1-800-525-9556. Thanks as always for listening, and we hope you have a great week.